The global currency war has entered a new phase. For decades, the US dollar ruled the world's finances without a challenge, but that era is over. The battlefield is now everywhere, from the mines of Australia to the farms of Argentina. While China quietly builds a new financial empire, one trade deal at a time, the United States is panicking, spending billions just to hold its ground. The world's financial order is fracturing, and the fight for control has begun. China just made a move that was unthinkable a decade ago. It banned all new iron ore shipments from BHP, the world's largest mining company, unless they were priced in Chinese Yuan. This isn't just about minerals, it's a direct attack on the dollar. China buys 70% of the world's seaborne iron ore, and they are now forcing the world's most critical supply chain to ditch the dollar. The message is clear: trade with us, but use our currency. Markets reacted instantly, with iron ore prices jumping and BHP's stock plummeting. This is part of a broader strategy where Beijing is weaponizing trade to shift financial power from the dollar to the yuan. Meanwhile, in Washington, panic is setting in. To stop Argentina's collapsing economy from falling into China's orbit, the U.S. Treasury took a desperate gamble: a $20 billion bailout. Argentina's peso is in freefall, its inflation is over 50%, and its reserves are almost gone. This bailout wasn't charity, it was a costly defense of the dollar's influence in Latin America. But there was a catch. The deal forces Argentina to keep its exports priced in dollars, effectively trapping it in America's financial orbit. This move has sparked fury at home, with critics asking why the U.S. is sending billions abroad when its own citizens are facing economic strain. While America spends billions to defend the dollar, China is strategically turning the crisis into an opportunity. Within days of the bailout, Chinese state companies swooped in and bought 35 cargo ships of Argentine soybeans, all settled in yuan, completely bypassing the dollar system. The symbolism is striking. The U.S. pays to keep Argentina in its orbit, and China walks in to do business in its own currency. This shift is directly hurting American farmers, whose exports to China have plummeted, while imports from Latin America surge. For the world, it's a glimpse of an alternative system where access to China's market may matter more than loyalty to the dollar. The currency instability isn't confined to emerging markets. In Japan, a full-blown crisis is deepening. The yen has crashed to its lowest level in over 30 years. Japan's new government is prioritizing exports by keeping the currency weak, calling interest rate hikes stupid. But this comes with a dangerous trade-off. A weak yen makes essential imports like food and energy brutally expensive for Japanese families, fueling inflation and eroding savings. The Bank of Japan is trapped, unable to raise rates without collapsing under the government's massive debt, which is a staggering 260% of GDP. This creates a vicious cycle where interventions to stabilize the economy only weaken the yen further. The cracks in the global financial system are spreading faster than anyone can patch them. China is aggressively building a yuan-based trading bloc. The United States is spending frantically to defend a weakening dollar empire, and key allies like Japan are crumbling under the weight of their own economic policies. The dollar's unquestioned reign is ending. The contest for control is now the defining struggle of the global economy, and the next crisis may not start on Wall Street, but in the currencies that keep it alive. The question is no longer if the system will change, but how long America can keep paying to stay on top.